Every single month, millions of American homeowners write a check for something that they don't understand to protect someone who isn't them. That's PMI, or private mortgage insurance. And the wildest part, it protects the lender if you don't pay your mortgage and not you. And most lenders will let you pay for it years longer than you actually have to. Today I'm going to explain exactly what PMI is, what it's actually costing you, and 3 ways to kill PMI that your lenders will not voluntarily tell you. Welcome to the Jimmy Knows Loans channel, and let's go. There's a scenario in the mortgage world that I've seen play out countless times. Someone comes to buy a house and they put less than 20% down. Here's what the lender usually says: this will drop off eventually. And the buyer, overwhelmed, nods their head, overwhelmed by everything that's happening at closing, and quickly signs off, never asking the question again about private mortgage insurance. Now let's fast forward 5 years later and they're still paying that PMI, $150 extra a month. But in that same 5 years, they built up equity. They've owned the home for a 5-year span. Maybe they're at 22 or 23%. But nobody called these buyers and homeowners now to say, hey, you can drop this PMI and you can do it now. Here's the thing, lenders are not required to proactively help you cancel PMI early. They are required to eventually cancel PMI, but only once you hit 22% equity of your original purchase price. That silence from the lender causes the borrower or homeowner to pay anywhere from $4,000 to $8,000 in unnecessary PMI payments. And I'm telling you, I'm done watching it quietly happen. So let's really dig into what PMI, or private mortgage insurance, is. PMI is a monthly added fee to your mortgage payment when you don't originally have the ability to put 20% down onto the new home that you're buying. The fee usually ranges from 0.5% to 1.5% of your loan amount per year, but broken into monthly payments. So for example, on a $350,000 loan, that's an extra $140 to $430 on top of your monthly principal and interest payments, your tax payments, and your insurance payments. That can add up pretty quickly. And here's the thing I want to be crystal clear about. PMI protects your lender if you default on the loan. It doesn't protect you. You're essentially paying on a monthly basis to protect them. Under the Homeowners Protection Act, your lender has to automatically cancel the private mortgage insurance that you're paying on a monthly basis whenever you hit 78% loan to value on the original purchase price of your home. Not what the home is worth now, what you paid for originally for the home. That's why knowing the 3 ways to proactively cancel PMI actually matters. So let's go over method 1. Requesting cancellation of PMI at 20% equity of the original price you paid for the home. Not 22% where it automatically cancels, but 20% of the original price of the home. At 20% equity, you have the legal right to request cancellation of PMI in writing to the lender. You must be current on your mortgage payments and have good payment history on any of the previous mortgage payments that you've made. The reason this is important is that lenders do not have to call you and won't call you when you've hit 20% equity. But what they do have to do is cancel it when you ask. Most people don't know to ask, but now you do. You can calculate this yourself. Take your original mortgage balance, multiply it by 80%, and that's the new balance number that you need to reach. You can also track your amortization schedule. Reach out to your lender for an amortization schedule and they have to provide this. Let's get into method 2. Request a new appraisal from your lender to show appreciation value over the time that you've been in the home. This is the one that almost nobody talks about. If your home has increased significantly due to market improvements or personal home improvements, you can reach out to your current lender, tell them that you want a new appraisal onto your current home with the current market value, and then you can use that new appraised value up against your current loan balance to calculate what sort of equity you have. If you bought a home for $300,000 and put 5% down, and now the home is worth $360,000, your equity just jumped drastically. Many lenders will allow you to request PMI removal with a new appraisal based on your current loan to value percentage, just if you've made 2 years worth of timely payments. You'll pay anywhere from $400 to $600 for the appraisal, and if that removes $150 worth of PMI payments, you break even in about 3 or 4 months. What you can do right now is call your loan servicer and ask them what the process is behind ordering a new appraisal and canceling PMI based on that new appraised value. They start to give you the runaround, usually means it's a red flag. Now let's hit method 3, refinancing into a new mortgage loan, and we need some help with the market for this to make sense. If rates have dropped since you last bought, or you've had massive credit improvement, doing a refinance or restructure of your loan can remove PMI entirely just through the refinance process. The reason being is, during a refinance or a restructure process, you're able to reset the loan to value ratio because there's going to need to be an appraisal done on the new market value of your home. This is also the only way to escape the lifetime mortgage insurance premium that comes with an FHA mortgage. Yes, refinancing has its costs, but if you can roll out of PMI with a lower interest rate, the math usually works out. We'll do a full deep dive into refinancing strategy in a later video. So now that we've went through the 3 methods to eliminate PMI, I'm going to give you 3 key insights of PMI removal. Insight number 1 is your lender's timeline to remove PMI is not your only option. The law gives you the right to request at 20% equity. Use it. Put it on the calendar from day 1, calculate the day that you'll hit the 20% equity, and schedule the call immediately. Insight number 2. Home appreciation is leverage that you're entitled to use. If your market's moved up, your home value's moved up, get an appraisal. A $500 appraisal to remove $200 a month in PMI is one of the best financial decisions you'll make in your life. Remember, most lenders entertain this request only after you've made 2 years of timely payments. Insight number 3, it'll just drop off eventually. Should be a trigger for you, not a comfort. Eventually can mean 10, 12 years. If you're on a standard 30-year amortization schedule, eventually is not a strategy. You need a specific plan and a specific date. If you're currently paying PMI and nobody told you about these options, that's why this channel exists. Drop your situation in the comments. Tell me how long you've been paying PMI, what your current rate is. Let's talk it through. Hit that subscribe button if you're tired about finding out about financial information after you needed it. That's why the Jimmy Knows Loan channel is here. Next video on the channel, we're gonna dive deep into the difference between an FHA loan and a conventional loan for first-time home buyers and figure out which one is the best. We'll see you next time.